The PSEi struggled again last week despite positive economic data and a surprise BSP rate cut. So what's weighing on the market and which stocks managed to buck the downtrend? Let's break it down. Hi everyone! Welcome to another episode of Intelligent Investing. I'm April Tan. After a brief rebound, the market lost steam again. The PSEi dropped 1.2% to close at 6,037.79, with foreign investors selling nearly 918 million pesos worth of stocks. Despite positive local data with lower inflation, better jobs numbers, and a rate cut, the market couldn't hold up as the peso's weakness overshadowed the good news. Let's break it down. First, inflation. The PSA reported that inflation quickened slightly to 1.7% in September from 1.5% in August. That's a 6-month high, but still below the median forecast of 1.9% and comfortably within the BSP's 2 to 4% target range. The rise came mainly from transport and food, particularly vegetable and oils, but overall price pressures remained manageable. Second, the job market improved. Unemployment dropped to 3.9%, down from 5.3% in July, as agriculture and construction rehired workers after bad weather disrupted activity. That sharp recovery supports the view that July's weakness was only temporary. And third, the BSP surprise rate cut. On Thursday, the central bank lowered its policy rate by 25 basis points to 4.75%. Governor Eli Remolona described it as a preemptive move, citing soft business sentiment and a benign inflation outlook. Interestingly, he also said the so-called Goldilocks rate might now be closer to 4% instead of 5%, implying there's still room to cut further if needed. Before this, remember during the August rate cut, Governor Remolona mentioned that, we are at a Goldilocks situation, meaning he was already happy with the 5% rate and said that, most likely we're done cutting rates for the year. Unless economic conditions deteriorate, then he will cut further. So because of that, I think a lot of economists were thinking, that will be the last rate cut already for the year. So, that was just August and, we're just in October. So most likely, even the economists who were thinking that the BSP would cut rates thought that the BSP would do it later this year after the Fed did more rate cuts. So cutting this early on came as a surprise to a lot of economists. If he's saying that the Goldilocks rate is at 4% and inflation is below 2%, then he can still cut. But despite all this good news, what really caught investors' attention was the peso's continued weakness. The currency slipped another 0.6% to 58.24 pesos, dragged by the narrower interest rate differential and a stronger US dollar, which climbed 1.3% week on week. Historically, a weaker peso tends to hurt equities, especially companies that import goods or have foreign-denominated costs. Well, for us, the peso really is a big threat. One of the things that we need for the Philippine market to go up is foreign investors. But if it looks like the peso is continuing to weaken, then the foreign investors will not return to the country. And if that happens, of course, that's not good for the market. Let's take a closer look at what moved the markets, as peso-sensitive companies were hit hardest. Pure Gold and GT Cap slid on concerns that a weaker peso would raise costs and squeeze margins. Banks also suffered. BDO, BPI, and Metrobank fell as lower rates could narrow their net interest margins. Surprisingly, rate-sensitive sectors like property and REITs didn't rally either. Ayala Land and A-REIT were sold down, while high-dividend telcos Globe and PLDT also declined amidst a risk-off mood. Adding to the pressure, investors grew cautious after reports resurfaced that the Keep Call Centers in America bill, which was filed in July, could hurt the country's $35 billion BPO industry, which accounts for a big chunk of the office demand. Even Plus, which announced a partnership with the 800-branch Bayad Center to offer an alternative payment platform for its online gaming clients, slipped 5.3% despite the positive development. It wasn't all negative though. Energy and exploration plays surged after President Marcos signed 8 new exploration contracts worth 11.6 billion pesos. PXP, APO, OV, and PX all rallied sharply. This as the first three companies own exploration contracts covering key areas in the Sulu Sea and Northwest Palawan Basin, while PX has a minority stake in PXP. Gold miners also extended their rally as gold hit another record at $4,018 per ounce, up 3.4%. Philex, LC, Manila Mining, and OGP were among the top gainers. I think what would happen is these companies will be allowed to drill in those areas, and then potentially they could see gas or get gas. One of the issues that we have is, of course, we import almost all of our energy needs. And of course, that makes us vulnerable during times of escalated geopolitical tension. And of course, that is bad for the currency because we need dollars to import all of that. So I think one of the strategy of President Marcos is to reduce our dependence on imported energy. And this is one way to do it because, I mean, the Philippines is located in the Ring of Fire. And that means that, we have abundant resources, including metallic resources and energy resources. In fact, we do have geothermal energy in the Philippines. We have, for example, EDC. It's just that the regulations are quite strict, and we're not maximizing these resources. So I guess, if you look back at the pandemic, that's one of the things that probably they realized is that we need to be more internally dependent rather than dependent on external sources. I don't think they award it regularly. This is the first time after a while. That said, just because you were awarded an exploration contract doesn't mean that you will succeed. You still have to do the hard work, and of course, you could also fail. You could try to explore, but then it doesn't yield positive results. So it's still very early days, still very speculative. But I guess the fact that those contracts are available is good news. This week, all eyes will be on global trade tensions. Last Friday, President Trump announced new 100% tariffs on China and export controls on critical software, effective November 1. This was in response to China's new export restrictions on rare earths and port fees on U.S. ships. The news triggered a sharp sell-off in U.S. markets, with the S&P 500 down 2.7% and the Nasdaq off 3.6% during the day. I think it could potentially have a similar impact as the Liberation Day tariffs in April. So during that time, remember, global markets, it's not just the Philippines, it's global markets reacted negatively given the magnitude and scope of the tariffs. Because, of course, the tariffs today versus that time are much lower. At the time, they announced very high tariffs. So the market responded negatively. That said, I think the 100% additional tariff on Chinese goods is quite significant at the time when people thought that, okay, now the actual tariffs are lower than the Liberation Day tariff. So kala nila parang the worst did not happen. But now it looks like, there's still uncertainty, it's not yet through. I guess what's different today compared to April is that, economic conditions in the U.S. are much weaker. So if I were a company and I now know that there's going to be a 100% tariff, I'm more inclined to lay off people kasi I guess my earnings are not as good. So what happened in April? Remember, the market went down sharply for a couple of weeks, and then even the peso depreciated. So we could see something similar happening. Flight to safe haven assets like U.S. bonds, U.S. dollar. Mas magiging ganun because of the uncertainty, we could see the markets going down. Locally, the peso remains the key risk factor. It's testing resistance at 58.40. And if it breaks higher, COL's technical analyst Juanes Barredo warns it could push towards 59.10. Meanwhile, third quarter earnings season kicks off this week. After 5 straight weeks of negative sentiment, stronger than expected results could be just what the market needs to find a bottom. Well, I'm a little bit more pessimistic about the third quarter. I think if I look at the second quarter, one of the negative surprises that we saw, for example, in the consumer sector, was the higher costs. In the second quarter, we talked about higher palm oil, coconut oil, coffee, and chocolate. And the problem is, if we look at those commodities, the prices remain elevated in the third quarter. So that said, maybe consumer names will continue to suffer from weaker margins. On the positive side, at least inflation remains benign. So we are hoping that at least the top line would be very good for consumer names. For the banks, again, with lower interest rates, I think investors will want to see whether the banks can maintain high margins. If loan growth remains strong, which should be still strong naman in the third quarter. And what about asset quality? Will it still be good? And for property, again, are we going to see a continuous recovery in take-up sales and an improvement in leasing revenues? So I think those are the factors that people are looking at, that analysts are watching out for. And hopefully, again, we're a little cautious, but if we see some surprises there that we didn't anticipate, then maybe that will help investors change their mind and turn more bullish on the market. After all, we are so cheap at this point. So to sum up, despite encouraging local data and a BSP rate cut, the peso's weakness kept the market on edge. This week, rising global risks, earnings results, and currency movements will be the key catalyst to watch. If you found this wrap useful, don't forget to like this video and subscribe for weekly updates on the market, economy, and stock picks. I'm April Tan. Thank you for watching, and as always, stay sharp, stay selective, and invest intelligently. See you again next week.